Hi, everyone, and welcome to the Adhesion Manager Spotlight for May 3rd, 2019. Today on the phone, we have Elizabeth Marchetti with WT Asset Management, who is the investment director for Wilbank Smith Thomas. Today, we're going to be covering the firm, getting to know them, their thesis as an investment manager, and covering the credit select risk managed model. So, with that in mind, Elizabeth, please take it away. Thank you.
Hi, everyone. Thank you for tuning in today to hear a little bit about us. As Patrick said, my name is Elizabeth Marchetti. I'm Investment Director for WST Capital Management. So my role is basically to liaise between our quant team and portfolio management team and sales advisors and our TAM partners. So to start, I think it'll help just to sort of explain who we are before hopping into the strategy that we have available currently. WST Capital Management is the ETF strategist division of Wilbank Smith Thomas Asset Management. Wilbank Smith Thomas is a Norfolk, Virginia-based firm founded in 1990. It was founded really as more of a wealth management shop, and that's where the majority of our assets are today. But I think our kind of origin story and history helps explain where we are now, and especially what WST Capital Management is designed to do. From about 1990 until the early 2000s, WST was run as a wealth shop that kind of focused on individual stock picking and individual bonds. And then in the late 90s, of course, it sort of blew up along with the rest of the market. So our founder and still managing principal got very interested in passive, became kind of a heavy DFA user. And around the time that these philosophical shifts were happening, smart beta was really taking off as a concept, and ETFs were beginning to proliferate and gather assets, and he just got very interested in ETFs as a new type of portfolio construction tool. So in around 2005, he got interested in one particular asset class that he wanted to be able to invest in opportunistically and really cyclically, and not kind of on a buy and hold basis. So he and the other portfolio managers began to kind of browse the investment marketplace for a trading vehicle that held high yield ETFs. And that tool didn't exist in the marketplace, so they decided to go ahead and build it. First by hiring a guy, I'll show you, Tom McNally. You see him at the bottom left. He had a technical trading background. He's one of like maybe 10 COT holders in the world. It's a pretty thin crew there, but he had a kind of growing body of work in trend following, and they brought him in to build what is now called Credit Select Risk Managed. So that's the origin of our very first track record. It was launched in 2006. So today, and over the course of about 13 years, we've expanded this platform to and really rounded it out to where we now have, we think, a pretty comprehensive set of asset class and multi-asset solutions, but they all sort of embrace the same and are driven by the same kind of core engine, which is it combines, what we're trying to do is combine trend following and machine learning with very deeply experienced portfolio management perspective. So we always think this is an interesting aspect of our story, the fact that we didn't sense a market opportunity in terms of ETF strategy. We literally just built the tools that we wanted to work with as portfolio managers and advisors. And for most of WST Capital Management's history, the assets have been really internal. We obviously seed everything ourselves, but only in the last 5 or 6 years have we really decided to bring these capabilities to the market. So what we're looking at currently is our team. We are a division of a larger company, so we feel uniquely, resourced from that perspective. But as far as WST Capital Management goes, we're pretty lean. Wayne Wilbanks is the managing principal and founding partner of Wilbanks Smith and Thomas. Roger Scheffel is the chief investment officer of WST, and Roger is an interesting story. He himself manages about a $300 million wealth book, but the majority of assets are in our own products. He's just a big believer in this type of vehicle and risk management, which is really the core of what we do philosophically. David Abrams is our quant. We always joke that, well, Dave believes he's exempt from wearing a tie because he's our quant. He has a Lego Millennium Falcon on his desk. So you know the quant when you see him. Tom McNally is, as discussed, sort of the person responsible for our flagship strategy. Dabney Tracy is our director of sales. I'm Elizabeth. Maria Marmion is our marketing strategist, and Ryan Stallard is the portfolio analyst who really is essential in getting our data and supporting due diligence and fielding questions around data, deliverables, and everything else. So hopefully you'll get to know us all very well. Are there any questions at this point?
No, I think we're okay.
Okay. All right. So I would say this slide here just sort of encompasses our philosophy. I mean, we, as a strategist, I would say we're very, very focused on the behavioral piece of the investment equation. We're not actually that focused on outsmarting the markets by understanding the markets better than anyone else. That's really not what we do. Our kind of key thesis is that investor behavior creates risk, and if you create as much risk in investment outcomes as the markets themselves do. I mean, we've all seen, the Dalbar studies that compare the average investor return experience on the S&P to what the S&P itself has done, and it just drives home the idea that repeatedly and understandably, volatility really psychs people out and drives short-term decision-making. So our thesis is that if we can control investor experience of risk in the markets, we can limit the amount of risk that investor behavior creates. So our solution there is risk management. We're really not trying to, and would never say that our strategies are going to get you 100% of the upside in any asset class. What we're saying is that we'll participate robustly when trends are supportive, but overall what we're trying to do is preserve capital and over the very long term outperform by managing downside risk that's inevitable in markets. We, again, as I said, the trend following is really the roots of the credit select strategy, but we have over time sort of refined how it works based on the quant capabilities that Dave Abrams has brought to the platform. So we build these strategies. They're machine learning oriented, but we as portfolio managers define the rules according to what our experience is. This is just, because we're always asked where do we sit in the active passive debate, and then increasingly, the discussion around factor-based investing. We consider ourselves active managers. We are tactically moving around betas that we're very specific about. So we think that we kind of combine what we consider the strengths of a lot of different investment traditions. We're active in the sense that we're dynamic and responsive to market conditions, but we believe that we leverage the best aspects of passive in that that we're not making a call on Apple versus Google. We may make a call on a specific type of beta. For example, in the strategy that we're about to discuss, security selection comes into play, so it's not just binary high yield on off using the broadest possible exposure. We'll say we think that the Fallen Angels ETF offers a really interesting relative value play right now. So security selection comes into it, but at the end of the day, we're not selecting the individual bond or stock or what have you. And in that sense, we feel like we bring a lot of the efficiency and obviously the diversification benefits of passive. In terms of factor-based, we're sort of running with those principles, but expanding on them, and we just flexibly define what is a factor to us. Because a factor to us could be any combination of traditional factors weighted in a way that we consider the most compelling based on our long-term analysis of historical trends in the market. This is something we can kind of gloss over. People get very interested in how the top-down inputs from portfolio management interact with the machine learning piece, but basically we author the models, and they run primarily off their own discretion based off quantitative trends and the proprietary quant framework that we've built. Again, this would probably make more sense outside the scope of this call, because I know we're focusing on credit select risk managed, but a lot of our broader multi-asset strategies leverage submodels, independent submodels that we also use as standalone strategies. So, but that'll be call number 2, I guess. So I guess I'll dive into credit select risk managed, because again, this is really kind of our flagship. And I think it best embodies our origin story and what we're trying to address. Credit select risk managed, basically it's just risk managed high yield investing based on a bunch of kind of proprietary trends that we've tried to define. We begin with the proprietary sub-universe of specific high yield securities that define the trends that we invest off of over multiple time horizons. At any given time, the strategy could be 0 to 100 in high yield, and obviously whatever's not invested in high yield is in what we call the alternate segment. The alternate segment, I think over the years we've gotten better about more flexibly defining that universe, the risk off component. So we're not just going to sit there in cash. From time to time we might, and cash is not unappealing currently, but the model is now able to make the judgment between the risk return trade-off of cash versus buying the ag and risk off. So duration management is within the alternate segment an important aspect of what we do. And in market conditions where spreads are very tight and you might be on the sidelines for a prolonged period, you want to keep that allocation productive. And from an advisor perspective, of course, it would be really hard to put in front of your client a product that's just going to sit there in cash for 3 months at a time. So we've really worked to define, to sort of redefine how this product looks and behaves when it's not just in high yield. So I'm going to skip ahead. So this is the full track record of credit select risk management. This is cumulative returns since its inception. The focus of this chart is really just to explain the core of what we do is manage drawdown risk and try to sort of slowly chip away at the upside of a given asset class by not losing as much on the downside and by participating when risk conditions justify participating. As you can see, we've now been through a couple of pretty significant drawdown events in high yield. We're not going to promise you that over the next 15 years we're going to get you to the same point as the S&P, but this is really all we're trying to do. It's just slowly compound by being in when it makes sense and by managing drawdown risk. Track record. So this here, we hope that these slides make sense to everybody because we really think that they tell the story well. And again, this is the most important sort of thing to think about as an advisor is how does this strategy fit in? And we think as advisors move towards outcome oriented investing and objectives-based investing, which is a very healthy trend. The way that we can best serve advisors is to set expectations and very clearly explain what you can expect from our strategies. So this here is just illustrating the effects of combining our strategy with the ag. So this line here shows you that when you combine Credit Select Risk Managed with AGG, just the Barclays Aggregate Tracking ETF, the impact is this. And this is what we're looking for, moving risk to the left in an efficient frontier without much give up of return if you're dealing with risky assets, and shifting the return number up if Credit Select is the more aggressive component of this allocation. HYG is just the kind of go-to high yield ETF. As you can see, it gets you obviously very nice, nearly 8% return over 3 years, but your risk is pretty significant here. So if you incrementally allocate to Credit Select versus incrementally allocating to high yield, you end up with a much sort of tighter range in terms of risk and pretty compelling upside participation. This chart's obviously more dramatic since inception because it captures the value that we were able to add relative to just bare high yield in 2008. This is another one that we've been focused on. The more we engage with advisors about how they're using our products, the more sort of interesting use cases we become aware of. We'll, for example, learn that somebody is using our strategy on top of laddered bullet shares or even individual corporate bonds. So we get interested in, okay, what do we do to just a laddered core investment grade portfolio? And, over 3 years, here's your answer. We've also become aware of, other creative uses. I think this may not be super applicable for this crowd, but we're aware of advisors using our strategy on top of a liquid debt allocation, just kind of as an overlay. And we believe in that sense we can dampen risk and obviously provide a liquidity portion that is remains productive and accessible while your money's tied up in whatever private opportunity. I think I'm right at 20 minutes, and hopefully that all made sense.
Yeah.
So I guess now, any questions?
That was great. Thanks so much, Elizabeth. So we have a couple questions. One, so just to kind of place this product in context, sort of what you're doing there near the end of the presentation, would you say describing the Credit Select risk model as a more efficient high yield option than, say, HYG? Would that be accurate?
Yeah, I suppose it would depend on what your definition of efficient is, but yeah, if you look at the chart up top, that's exactly what we're trying to do. I think opportunity cost of risk management is it hurts more in some market phases than in others, but overall, efficiency seems like a worthwhile investment when markets are acting up like they did in fourth quarter. But that's definitely what we're trying to do. And right now, especially, we looked at this coming out of the first quarter. The high yield index is outperforming or is right on top of the S&P 500 value for the trailing 1 year period. I think a lot of that is structural pressure on value, but a lot of that is also this asset class has done very, very well. So, what goes up? It's that principle, and really that's what we're trying to do when we compare ourselves to HYG. Saying we definitely did not give you all of the robust upside over the trailing period, but when drawdowns occur, and again in fourth quarter, I think Credit Select was down peak to trough just under 2% versus the full 5% drawdown for high yield. So efficiency is certainly what we're going for.
Fantastic. And downside risk management is hugely important to many of the advisors on the Adhesion platform. So it looks like,
Right.
the credit select model really does help accomplish that. And I did
Right.
want to, uh, next question here is, so a lot of when it comes to the actual process for running this model, you know, results are great, and they really do kind of help get a sense um, over the overall model. But when it comes to just the day-to-day, month-to-month, quarter-to-quarter
Mm-hmm.
running of the actual product, what does your process look like? Um, so how does it, I guess, how does the team operate there?
Yeah. So a lot of these strategies are primarily about kind of design on the front end, and we can refine them. But back to our thesis about investor behavior creating more risk in investing, um, that belief extends to us as portfolio managers. We make mistakes. We get concerned about risk. We get spooked. We're susceptible to the same type of anxiety as the average investor. So we've removed ourselves from that equation by building these models and then letting them run. We monitor them constantly, and refine them. Like I was saying, we've done work over the years to refine what the alternate segment looks like and how it behaves in risk off periods. So day to day, really how Credit Select in particular is built is that Tom McNally has identified what he calls his sort of proprietary leading indicator of the high yield market. And he looks for a set of securities with very, very specific characteristics. Whereas the high yield investors may be overly focused on energy issuers, which is really what led to the kind of 2015 meltdown. Tom, in defining his universe, may be able to weight that factor or sort of underweight it in terms of the importance to the model. So he builds this proprietary set of high yield issues that, based off of which the trend, or actually it's a set of trends that this model follows. They are driven by that proprietary sub-universe. So day to day, the Credit Select allocations are driven by the model's assessment of trends based on that universe. In terms of our ongoing sort of involvement in it, as I mentioned, Tom can submit new securities into for consideration into the model universe. So last year, it picked up ANGL, which at the time felt like a relative value play, because everybody thought high yield fundamentals were so strong. So the lower quality end of the high yield spectrum was a little overbought relative to these fallen angels, which were just south of triple B status. So we have the ability to do that. If we, for example, become aware of a short-term treasury ETF that is cheaper and offers better liquidity, or whatever characteristic we're looking for in that allocation, we can sub it in and out. But in terms of how the model behaves day to day, I think our turnover, I think it averages just under 400% a year, but that's very, very cyclical. In second and third quarter of this year, I think there were maybe just a couple of trades, and then in certain years, you'll see a lot more activity. Spreads are very narrow, so you can expect to see this trade a bit, or pretty actively in an environment like this. But I would say you could expect to see maybe one or two trades a quarter, depending on how markets are behaving.
Fantastic, thanks. And last question on our end here. How many assets do you guys typically hold within the model? How many different securities?
It depends on the level of investment in high yield, but I would say about 8, because within the high yield allocation, as I've explained, we sort of manage duration in the alternate segment, but we do as well in the high yield segment. So we could be holding shorter term high yield or shorter duration high yield, and then market duration high yield, and that washes out to, could be 3 to 4 high yields ETFs, and then 3 to 4 on the alternate segment side. I think maybe the highest it can go is 10. But I would say when it's fully allocated, you would expect to see um, probably 5 to 6, and when it's sort of half in, half out, we tend to diversify a little more, and you would see about 8.
Fantastic. That sounds great. Awesome. I think that's all the questions that we have for you, Elizabeth. So
Okay.
any advisors listening, please, if you have questions on the credit select risk model or want to get in touch, please feel free to reach out to your relationship manager. We're more than happy to um, reach out to WST on your behalf, and we can go ahead and get those answers that you need. So, Elizabeth, I want to thank you very much for your time today.
Yeah, thank you, everybody.